Mike Tedeschi, Portfolio Manager over at Perspective Wealth Planning. The inflation's number came in today hotter than expected. There's a number of areas of this market that are trading at key levels. I want to jump in and take a look at those today. But first, we're going to take a look at the four major U.S. indexes. Then we're going to look at growth and innovation, transportation stocks, the semiconductors, utilities, home builders, and last but not least, we will take a look at healthcare. Let's take a look in at the S&P 500. We did have our confirmed break to the lowest closes of the year underneath of that 4,100 level here over the last couple of sessions. We left this trading range that we had been in really since January or so. That was not a good sign for the bulls. And as we take a look at some of the other indexes, you'll see the NASDAQ much worse off than the S&P 500. We've talked about that a lot so far this year, all the way back to the breakout from 2020, the second half of 2020 at this point in time. If you take a look at the S&P 500, that breakout from 2020 still all the way back down here. So the S&P 500 has held on to a lot more of the gains than the NASDAQ has. We jump in and take a look at the Russell. The Russell is all the way back to that 2020 level as well, the November breakout spot. It has pretty much undone the entire run-up post-COVID. The NASDAQ broke out earlier in the year than any of the other indexes in 2020. That breakout still all the way back down here at 98. So we can clearly see that the Russell is doing the worst since 2020, all the way back to this key 1700 level here over the last few sessions. A break underneath of that will undo the entire breakout post-COVID for the Russell. Now, the area of the market that has held up the best so far has been the Dow. The Dow is back to a spot that it was at in 2021, so we're not even close to talking about areas back in 2020. That would be all the way back at 29,000. We're still over that 3,200 level, though it did make new lows for the year. It's bounced back up, and it's trading right around the lows that it was trading at in March. And one of the things that we have clearly seen so far this year and for the second half of last year is the move away from growth and back into value names. And that's why we're going to take a look at these different sectors here. First, let's talk about the worst performing area of the market, and that would be growth and innovation. We'll take a look at the ARK Fund. Here's the breakout spot from 2020. That's that 60 level. The coronavirus lows were all the way down at 33. We're not that far off, meaning the growth area, which led the market, we had almost a 400% gain into the beginning of 2021. From that point forward, is now down about 75% and almost undone everything that this area of the market has done in the past few years. In fact, we're trading back to levels that we saw at the end of 2017 in this area. A lot of names in this space down 80, 90%. And if you think about it, it all has to do with the cost of borrowing money. Right? A lot of these companies were disruptive companies that had very interesting technologies, different areas of the market, but they all had one thing in common. They were typically burning cash in order to capture market share and really focus on that long-term kind of growth. And when money is cheap to borrow, that area of the market can see great multiples for those disruptive companies. When interest rates go up and money becomes more expensive to borrow, these companies fall under a tremendous pressure. We've been talking about that a lot for the last 6 months, and that trend continues to stay in play. Now, the areas of the market that are at key levels that are really important to pay attention to, let's start by taking a look at the transportation stocks. Now, the transportation stocks took out and made a new low for the year over the last few sessions. The breakout spot, and again, we talk about this all the time, the levels of support and resistance are not one number, they're zones. And the zone is this 240 to 230 zone. Underneath 240, this whole move is particularly suspect, but underneath 230, I would say you kind of have that confirmed leaving of this multi-year range that we had in on the transports. Transportation stocks we always pay very close attention to because that's what's moving goods throughout the economy. And when this area of the market starts slowing down, right, it's very concerning for the health of the overall economy. The other area that we like to take a look at is the semiconductors. The semiconductors are definitely a risk-on area of the market. When the semiconductors are performing well, companies are spending additional monies, upgrading their infrastructure. Economies tend to be working very well. We're trading right there on that 220 zone. We did go and make a new low for the year. We broke underneath of that 240 area that we were talking about in the video a couple of weeks back. We are right back to that the end of 2020 breakout spot at 220 on the semiconductors. What happens here is very, very important. We break that move all the way back to the 2020 breakout spot, still all the way back down here, right? If the market ran higher on all of that easy money, and that easy money is coming out of the market, we can certainly give that whole move back. And so what happens here, really, really important. Utility stocks have been leadership, right? That is late market cycle conditions. Utility stocks should not be the stocks that are leading us, leading the market, right? That means we are at a defensive posture. That is clearly what we have seen so far this year. We had that big push in March. It pulled back with the overall market, but it pulled right back to that same spot. I would very closely watch that 70 zone for utilities as a level to hold against. And if we get back up over that 72 zone, that does put those highs back at 77 back on deck, right? This area has been working. You can see clearly we are in that uptrend with higher highs and higher lows for the last 2 years. We need to take out the 77 to continue that trend, and if we hold again this 70 low, we still have those higher lows in place. So we're really watching what happens here. One of the other things we like to take a look at for the health of the overall economy is the home builders, right? Interest rates rising, making it more and more difficult to afford a house, right? The extra couple of percentages on a 30-year mortgage is adding hundreds and hundreds and hundreds of dollars to people's mortgage payments, making the cost of homes that they can actually afford on that same monthly budget less, right? We have seen the home builders really get hit hard so far this year. And look where they're trading at. They're trading at that major key important zone right there at that 59 level. That's that break from the end of 2020. As you can see, we're seeing a lot of these charts with areas of the market looking to potentially give back the entire run-up type moves that we had off of the 2020 breakout. This is a very treacherous market in a lot of areas. One of the other areas that has done better but is also trading on a really, really important level is healthcare. This is another kind of defensive area of the overall market. It is still holding on to this 124 low zone, and that's the breakout from June in 2021, right? The 2020 breakout is all the way back down here. So you can see this is trading well above, you know, where the home builders are essentially in terms of where they were at a year or so ago. This level is very, very important for the healthcare stocks. You want to see this area hold. If it does, you're still kind of trapped in that range, upper end of that range, resistance like 138 to 140. But this is another area that's sitting precariously right there on that zone of support. And there's that old adage, the more times you test support, the higher likelihood that it is to break. 1, 2, 3, here's your fourth test. Right? We're still technically in this range, but the more times we come down and we test this zone, the higher likelihood we have to break lower. So we are going to pay very close attention to these areas of the market as well as the overall market moving forward, because there are certainly a lot of key levels in play here with that extreme market weakness that we saw across the indexes over the last week. As always, I hope you guys found this content useful. If you've got any questions, feel free to reach out to me at mtedesky@perspectivewealthplanning.com, or you can give me a call at 814-580-9881. Hope you guys have yourselves a fantastic day. I'll see you guys tomorrow. Take care.